In recent developments within the financial world, renowned investor Michael Burry has made headlines by announcing his decision to deregister his hedge fund, Scion Asset Management. His reasoning is significant, characterized by an unsettling forecast for the stock market. Burry expresses apprehensions about a potential multi-year downturn, citing a fundamental shift in market dynamics driven by passive investing. In his view, the stock market is currently on shaky ground, with predictions of several challenging years ahead. This perspective starkly contrasts with the early 2000s dot-com bubble, where certain ignored stocks had the potential to recover even amidst widespread downturns. Burry articulates his concerns by pointing out the sheer volume of money now tied up in passive investment strategies, which he believes could exacerbate a market decline. He asserts that the current landscape lacks the resilience seen during previous downturns. Burry emphasizes that if the market were to dip, the ramifications would be more widespread, affecting nearly all stocks rather than just a select few. As he puts it, the interconnectedness of today's market makes it difficult for investors to find solace in long positions when the broader market faces turmoil. This stark outlook prompted Burry to exit his fund management role entirely. Moreover, Burry's investment strategy reflects his cautious stance. In conjunction with his fund's deregistration, he took immediate action by placing put options on high-profile tech companies such as Nvidia and Palantir Technologies. His investment choices have garnered considerable attention, particularly his bearish view on Nvidia. However, Burry has also turned his critical eye towards Palantir, highlighting its stock-based compensation policies that seem disproportionate to its revenue. He draws a relevant comparison with industry giant IBM, suggesting that Palantir's claims to uniqueness may not hold when scrutinized. Burry's critique doesn't stop there. He elaborates on the broader implications of stock market behavior, likening the current climate to what he describes as a data transmission bubble during the dot-com era. He argues that we are now in a phase where announcements of capital expenditures related to artificial intelligence can result in outsized market cap increases. This phenomenon reinforces his belief that an unfettered rise in stock prices based on speculation and hype may not be sustainable. Interestingly, Burry suggests that if there's any sector worth considering for investment during these turbulent times, it would be out-of-favor healthcare stocks. This recommendation contrasts sharply with his outlook on technology and growth stocks, which he believes are significantly overvalued. He acknowledges the complexities and risks associated with the US economy, cautioning against the folly of betting against it, despite concerns over government finances. Burry's insights come from a place of considerable experience and acumen in financial markets. As the investor who famously predicted the housing market crash and profited from it, his analysis carries weight. Lately, he has been more vocal about his views, leveraging social media and even launching a new Substack to share his thoughts with a broader audience. His dialogue with Michael Lewis, the author of The Big Short, further sheds light on his journey and decision-making process. As the financial landscape continues to evolve, Burry's warnings should not be taken lightly, especially for those actively engaged in the stock market. For the latest economic news and insights, remember to like and subscribe.